The markets are closed. The ticker tape has gone silent. For the first time in days, the price of silver is not moving at all. It is frozen at $71.91. Most investors look at this stillness and feel a sense of relief. They assume the battle is over for the week. They believe they can relax, pour a drink, enjoy the holidays, and wait for January. But professional traders know better. The silence is not safety. It is the calm before the most unpredictable storm of the entire year. We are entering what Wall Street calls Ghost Week, the 7 days between Christmas and New Year Nest Day. This is the period when senior risk managers, hedge fund leaders, and central bankers leave their desks. They head to Aspen, St. Bart's, and private retreats, leaving behind a multi-trillion-dollar financial system. What remains is a market run by algorithms and junior traders, and that combination creates a dangerous environment. Liquidity evaporates. In a normal market, it takes billions of dollars to move silver by $1. During Ghost Week, it may take only a few million. In this urgent holiday update, I'm explaining why the next 7 days could deliver the most violent volatility of the year. Holding $71.91 going into this liquidity vacuum is both a victory and a risk. I'm also giving you the survival guide for trading when the lights go out on Wall Street. The adults have left the room. The machines are now in charge. Let's start with the weekly close. Silver finished at $71.91, up more than $1 on the day and sharply higher on the week. Technically, this was a perfect performance. The breakout held. Price did not collapse back to $65, but pay attention to the final hours of trading. Silver pulled back from the high of $72.42. Why? Because traders were squaring positions. No one wants to be a hero on Christmas Eve. Smart money took profits to fund the holidays. This is normal and healthy, but it leaves the market in a fragile position. We are hovering just below all-time highs. At the top of the mountain, the air is thin. It takes only a small push to send price sliding lower or to launch it straight into the stratosphere. The market is coiled with stored energy. When futures reopen for the half-day session, that energy must be released, but there will be very few humans left to control it. Picture a trading floor at JP Morgan or Goldman Sachs. Normally it is loud and crowded, hundreds of traders, phones ringing, orders flying. Tomorrow morning it will be a ghost town. Maybe 3 people will sit at desks meant for 50. This skeleton crew is under strict orders. Do not take risks. Do not make big bets. Just keep the lights on until January. That sounds safe, but it is actually dangerous. If breaking news hits, Middle East tensions, a mine strike in Mexico, the junior traders lack authority to stabilize the market. They cannot deploy capital to absorb shocks. If a large sell order hits, they step aside and let price crash. If a large buy order hits, they step aside and let price spike. The shock absorbers are gone. Market makers who usually smooth volatility are absent. This opens the door to flash crashes and flash rallies with no fundamental cause. With the humans gone, the robots take over. High-frequency trading algorithms do not take holidays. In normal conditions, human judgment counterbalances machine behavior. During Ghost Week, algorithms dominate. They feed on momentum. If price starts falling, they short aggressively, triggering more selling in a cascade. There's no human voice saying the price is irrational. The same applies on the upside. A break above $72 can ignite a melt up towards $75 or even $80 on almost no volume. This is why technical levels fail during Ghost Week. Support and resistance become tissue paper. With no liquidity to defend those levels, the machines tear straight through them. Another major danger is the spread, the gap between bid and ask. In normal markets, it's a penny. During Ghost Week, it can widen to 20 cents, 50 cents, or even a full dollar. Market makers demand huge premiums to take risk. This means trading becomes expensive and dangerous. A market buy could fill at $73 when price shows 72. A market sell might fill at $70. You lose money just entering and exiting. That is why the number one rule of Ghost Week is simple. Do not trade, do not use leverage, do not scalp. You're playing poker against a machine that sees your cards, in a casino that takes a massive cut every hand. For long-term holders of physical silver, this noise does not matter. Your ounce does not change value because spreads widen. But for screen watchers, it can be terrifying. Ignore the noise. This is the liquidity vacuum. In part 2, we dive deeper. We examine historic holiday crashes and rallies. We visualize thin order books and show how tiny orders create massive price moves. Despite the danger, this week is statistically bullish. With sellers absent, prices tend to drift higher. Silver could reach $75 before New Year's Eve, simply because gravity has been turned off. The market feels peaceful at $71.91, but that peace is an illusion. Liquidity is like ice on a frozen lake. When it's thick, you can drive a truck across it. During Ghost Week, the ice becomes dangerously thin. One wrong step sends you straight through. An empty order book looks like a ladder with missing rungs. Sellers may sit at $72, then nothing until $70.50, then nothing until $73. When an algorithm buys, price doesn't climb. It teleports. Gaps appear. A $10 million order behaves like a $1 billion order. Momentum is upward, so the vacuum pulls price higher. This leads to the Santa Claus rally. Historically, markets rise in the last 5 trading days of the year and the first 2 of January. Why? Because short sellers go on vacation. When sellers disappear, prices drift upward naturally, slowly, relentlessly, without news. But thin markets are fragile. Flash crashes can still occur. A fat finger error or predatory algorithm can knock price down, trigger stop losses, and rebound minutes later. Leveraged traders get wiped out. Physical holders remain unaffected. Now look at the physical market. Dealers are technically open, but premiums have exploded. Silver Eagles are nearing $90. Dealers are protecting themselves from gap ups. They don't want to sell today and replace tomorrow at much higher prices. This confirms the shortage. The real price of silver is what you must pay to get it, and that number is rising fast. Ghost Week is the calm. January is the tsunami. In part 3, we examine the January effect, pension fund rebalancing, and why billions in institutional money are lining up to buy silver. The calendar is ticking. January is a reset button. Pension funds must rebalance. Silver was the top performing asset. Career risk forces managers to buy. Even a 0.1% allocation from global pensions equals 50 billion twice annual mine supply. The silver market cannot absorb that. Price must rise to ration demand. Silver is being pulled higher by the collapse of the 60-40 portfolio. Stocks and bonds no longer protect capital. Institutions need a non-correlated asset. Crypto is too volatile. Real estate is illiquid. Silver is next. That leaves commodities. And within the commodity complex, silver stands alone as the only asset that is both strategic and monetary at the same time. It is the perfect hedge. Because of this, 2026 will mark a structural shift in global asset allocation. Institutional allocators are going to carve out a permanent slice of their portfolios, specifically for strategic metals. This means the buying we see in January will not be a one-off trade or a short-term chase. It will be a persistent, ongoing bid. Every month, as payroll contributions flow into pension funds, silver will be purchased again and again, month after month, year after year. This steady accumulation removes volatility and replaces it with a rising structural floor that never stops moving higher. Right now, during Ghost Week, volume is thin. We have discussed the liquidity vacuum. But on January 2nd, everything changes. Volume returns. The main trading systems switch back on. High-frequency traders come back online. Bank desks reopen. When the surge of volume collides with a market already suffering from supply shortages, empty dealer inventories, and frozen vaults, the result is explosive. High volume combined with rising prices is the most bullish technical signal that exists. It confirms that the rally is being driven by broad participation, not speculation. Ghost Week drift may carry silver to $73 or $74, but January volume has the power to push price through $80 in a matter of days. We are storing potential energy. A dam is holding back a river of liquidity, and that dam breaks next week. Capital is coming. Allocations are shifting. Volume is returning. What we are witnessing is the setup for a historic year in 2026. But the question remains, is the path forward straight, or will the system push back? In part 4, the conclusion of this holiday series, I will outline the full outlook for 2026. We will map the major macro events ahead, including the debt ceiling, the BRICS summit, and solar production mandates. And I will leave you with the final strategy required to survive what may be the most volatile year of our lives. Ghost Week is ending. The real game is about to begin. We have moved through the silence of the Christmas close. We have identified the dangers of the liquidity vacuum. We have tracked the massive wave of capital forming behind the January effect. Now we lift our eyes from the daily chart and look toward the horizon. The year 2025 is effectively complete. It was the year the breakout began. It was the year the $65 wall collapsed. But 2026 is the year the system itself begins to fracture. In this final chapter, part 4, I will lay out the strategic roadmap for 2026. We will examine the 3 massive macro forces scheduled to collide in the first quarter: the U.S. debt ceiling, the launch of a BRICS trade currency, and global solar production mandates. And I will give you the psychological armor you will need, because while silver is headed toward $100, the journey will be violent. You already hold the winning ticket. The only challenge now is holding it until the draw. The first catalyst of 2026 is already locked in, the U.S. debt ceiling. Washington postponed the problem, but the delay has expired. In early 2026, the Treasury runs out of cash. We know how this unfolds. Political theater, shutdown threats, default warnings, and then, at the last moment, more money printing. But this time is different. The debt is exponentially larger, and interest payments are consuming the nation's tax revenue. As the debt ceiling fight intensifies, credit rating agencies will threaten downgrades. Bond markets will panic. And when bonds become dangerous, capital runs to hard assets. Silver functions as a credit default swap against the U.S. government. Every debt ceiling increase dilutes the dollar. Every dilution mathematically forces silver higher to preserve purchasing power. This means fear-driven capital will pile on top of industrial demand. In Q1, Samsung will be buying silver for batteries, while hedge funds buy silver to escape treasuries. 2 engines, 1 price. Later in the year comes the BRICS summit. For years, the bloc has hinted at a trade settlement system backed by commodities and gold. If 2026 brings an announcement, silver is instantly remonetized. Gold becomes money, and silver follows. China understands this. That is why they are hoarding physical metal. This looming announcement hangs over the market like a sword. Short sellers know that a single weekend announcement could gap silver to $100 overnight. That fear alone creates a permanent floor. Banks are de-risking, and de-risking means buying. Then comes industry. Beyond batteries, solar mandates are accelerating. The US and EU have set targets that require solar installations in 2026 to double compared to 2024. Double the panels means double the silver, but mine supply is flat. This is the extinction math. In 2026, the wall is hit. A major solar manufacturer will halt production due to silver shortages. When that headline breaks, silver stops being a precious metal and becomes a strategic resource. Governments will panic. Hoarding begins. Export controls follow. This is not speculation. It is unfolding in real time. The supply chain is breaking. So what is the strategy? The price is $71.91. The year is ending. The pressure is building. The plan for 2026 is simple. Accumulate and sit. Do not trade volatility. Expect violent pullbacks. Banks will try to scare you. Media will call it a bubble. Ignore it. You know the vaults are empty. You know the debt is unpayable. You know industry is desperate. The only way you lose is by selling too soon. Buy dips if you have cash. If you hold silver, lock it away. Measure wealth in ounces, not dollars. The goal is simple. Cross the finish line with maximum metal. The verdict on Ghost Week is clear. We held the highs. We enter the new year strong. 71 to 121 is a victory. It proves buyers are stronger than banks. It proves the physical market is in control. Rest now. Because when January the 2nd arrives, the volume returns. The pensions deploy capital, industry panics, and the next leg launches. You are early. You are right. You are ready. Welcome to the year of silver.